G'day guys, and welcome to the first Trader Talk weekly newsletter. I'm your host Anthony Riley, and over the coming weeks and months we're going to be talking about ways in which you can improve your trading, which is ways that I've improved my trading and I've seen other people around me improve their trading. So a little bit of background about myself. I'm a prop trader in Sydney, Australia. I've been doing it for 6 years now, so I've certainly seen and experienced a lot in the trading space over time. And this whole newsletter really has come about with me seeing there's a lot of education and a lot of stuff out there these days that's very specific in general, but there's actually not a lot out there that helps a trader who already knows what's going on, help them continually be able to adapt and retain the high level of focus and everything that plays a part to really keep yourself at the front of the game to adapt with markets as they change. So each different week we'll have a different topic that we'll just focus on and we'll have a bit of a chat on. They'll all be over this sort of format through video. I think this is probably the best way to do it. So I hope you enjoy it. And the first topic today is volatility. So basically we're going to be discussing about how I generally adapt and modify or trade around the strategies that I run when the markets do become more volatile. Recently we've seen in the past month the S&P 500 has, even though it has been range bound basically, we've actually seen it be quite volatile in that as you compare it to, how it was in 2018 and earlier on in this year. We also had that move in oil over the weekend where from the gap on Friday to where the crude futures opened on Monday, the highs was almost 20%. So we're certainly seeing these bigger moves in the market. And when you go from trading in a period where there is not as much volatility in the market and you might build or learn a strategy in that period, you need to keep in mind a few important aspects that are going to enable you to be able to still trade that in times when the market is more volatile and there is more chance of you having bigger swings and more frequent swings. So let's get into it. First and foremost, I think the best thing for everyone, and I've learned this the hard way myself, is you've really got to know your strategy. I think that's very important. You need to know why your strategy works in different market conditions and why it doesn't. And for me, I know that over time, throughout my journey, I've had particular strategies, especially in the more fixed income markets, where the change in volatility changes the dynamic of the trade. So instead of, for example, if we're looking at different types of trades where you might run a 10-point stop on something like that, right? Or for example, as a currency trade, you might run 50 pip stop. But then the average true range of the market over this period now, we're getting increased volatilities, increased ranges. You have more of a chance of being stopped out because the market ranges have increased and you're still putting the stops in the same sort of places and not allowing this expansion to occur without trying to still limit your downside. But what you're forgetting is that with increased volatility, it goes both ways. You're also going to have increased potential to make money. So by keeping that in mind, one of the ideas or strategies that I've looked at, and I'm sure many of you guys listening might look at, is being able to reduce your size but widen your parameters. And that will give you the same effect. Sometimes people see volatility and it's like, I can make more. So instead of making, a 1-to-1 trade, I can make a 2-to-1 trade. Might not be the point. The point might be to still make a 1-to-1 trade, but to have a wider parameter so you're less likely to get stopped in all the noise that occurs. A lot of it as well, depending on the type of trader that you are, some people might say, yeah, but volatility doesn't affect me. I'm a FX swing trader, right? Volatility does affect you because if you're in a position and it's volatile, the spreads might widen and you might actually get stopped out just because of the spreads. So when it is more volatile to when it's not. So by understanding this and being a bit more lenient on the downside and making sure that you're still risking the same amounts that you would in the past, but you're adapting it to a more volatile market at the moment is definitely going to help you in times like this, especially if your strategy is very based on a particular volatility band, almost you could say. And doing things like this will just help you adapt and stay in the game so you don't get whipsawed out and become too demoralized. But then you've also got people like day traders. I mean, day traders, when I do day trade fixed income and equity index futures, most of this is done through reduction of size for me. I'll generally look to reduce it depending on the size of the moves. So I'll be using things like an average true range and the average size of moves during a day. And if they're above an average by a certain percent, I'll reduce the size to sort of adapt to that changing of the market. For me personally, I would prefer to keep the same risk across all market phases and volatility, not volatility and all this sort of thing. And it's easier for me to have that done by just altering and messing around with the size rather than sort of coming from the idea of like, oh man, now I can kill it because it's volatile, I can make double the money. Yes, no, you can also lose money quicker. And at the end of the day, you know, we want to be here to trade tomorrow. It's always the first and foremost, most important thing. And of course, the last as well is like if you're out there and you're a mean reversion trader, which I do a bit of myself. It's just all about that same thing: adjusting your risk, adjusting your strategy, making sure that if you're in a mean reversion trade and you're fading at 2 standard deviation in the volatile markets, you might go to 2.25 or 2.5 just to allow for that extra bit of volatility in the market. And that's what I think is very important. So a task that you can do is just look at the average sizes, the ranges of the trades that you take. Look at the type of ranges in the different markets. You know, is your product or what you're trading more volatile in 2018 than it is in 2019? How many trades there was? What could you sort of get out of that? And then if you look at now, you can look at like average range of each candle, and if you're seeing them increasing and you're seeing your trade frequency increasing, but you're also seeing your P&L swings a bit more, then maybe that's time to look at potentially changing something on that risk side, whether that be the sizing or the risk dollar amount. So that's pretty much it. Quick one. Hopefully you got some value from it. If there's any way I can improve these videos, obviously this is the first one, so they're going to get better as we continue on. But yeah, first of many. Volatility, we're fitting that it's today because it's FOMC tonight. It's in about 11 and a half hours. So we're definitely going to see some volatility. So definitely take some of these things on board. Let that think. If you do have any questions about this, let me know. And yeah, I look forward to seeing you guys next Wednesday. So have a good week, safe trading, and I'll speak to you all soon. Cheers.